Question 1. An investment advisor representative, IAR, is evaluating a client's portfolio and notes that the client holds a significant concentration in a single, highly volatile stock. The client expresses concern about potential downside risk but is reluctant to sell the stock due to its historical performance. Which of the following strategies would be most appropriate for the IAR to recommend to mitigate downside risk while allowing the client to maintain their long position? A. Selling covered call options on the stock. B. Purchasing put options on the stock. C. Selling uncovered call options on the stock. D. Purchasing call options on the stock. Answer: B. Purchasing put options on the stock. To mitigate downside risk on a long stock position while maintaining ownership, purchasing put options is the most appropriate strategy. This provides the client with the right to sell the stock at a predetermined price, the strike price, effectively establishing a floor for their potential loss. Selling covered calls generates income but offers limited downside protection, while selling uncovered calls or purchasing calls would not directly protect against the stock's price decline and could even increase risk. Question 2. Under the Uniform Securities Act, USA, which of the following would generally be considered an exempt transaction, thereby not requiring registration? A. An offer of securities to 50 residents of a state within a 12-month period. B. A non-issuer transaction in an outstanding security at a fair price. C. An isolated non-issuer transaction. D. An offer of securities to institutional investors. Answer: C. An isolated non-issuer transaction. An isolated non-issuer transaction is generally considered an exempt transaction under the Uniform Securities Act. USA, meaning it does not require registration. This exemption typically applies to infrequent, non-public sales of securities by individuals, not the issuer. Other options, like offers to a large number of residents or institutional investors, may require different exemptions or fall under registration requirements depending on specific conditions, while a non-issuer transaction at a fair price is not a defined exemption criteria. Question 3. A client, aged 55, is seeking advice on rolling over a 401(k) from a previous employer. They are concerned about potential taxes and penalties and want maximum flexibility with their future distributions. Which of the following options would generally be most suitable? A. Rolling the funds into a Roth IRA. B. Rolling the funds into a new employer's 401(k) plan. C. Rolling the funds into an individual retirement account. IRA. D. Taking a lump sum distribution. Answer: C. Rolling the funds into an individual retirement account. IRA. Rolling over 401(k) funds to an individual retirement account. IRA offers the most common and flexible option for avoiding immediate taxes and penalties while maintaining tax-deferred growth. A Roth IRA rollover would trigger immediate taxation on the pre-tax funds. Rolling into a new 401(k) is an option but may have less investment flexibility than an IRA. Taking a lump sum distribution would result in immediate taxation and a potential 10% penalty if the client is under 59.5. Question 4. An investment advisor. I manages a portfolio for a trust. The trust document specifies that the trustee has a fiduciary duty to preserve principal and generate reasonable income. The IA recommends a portfolio heavily weighted towards high-growth, small-cap stocks. This recommendation would most likely violate which principle? A. Best execution. B. Suitability. C. Fiduciary duty. D. Disclosure requirements. Answer: C. Fiduciary duty. This recommendation most likely violates the investment advisor's fiduciary duty to the trust. A fiduciary duty requires the advisor to act in the best interest of the client, adhering to the specific terms of the trust document, which in this case prioritizes principal preservation and reasonable income. A portfolio heavily weighted towards high-growth, small-cap stocks, while potentially offering high returns, carries significant risk and may not align with the trust's mandate for principal preservation and reasonable income, thereby breaching the fiduciary obligation. Question 5. Which of the following investment vehicles is most likely to experience significant price fluctuations inversely related to interest rate movements? A. Money market fund. B. Floating rate bond fund. C. Long duration, low coupon corporate bond. D. Equity income mutual fund. Answer, C. Long duration, low coupon corporate bond. Long duration, low coupon corporate bonds are most sensitive to interest rate changes. Bonds with longer maturities and lower coupons have higher duration, meaning their prices will fall more significantly when interest rates rise, and rise more significantly when interest rates fall. Money market funds and floating rate bond funds have very low interest rate sensitivity, while equity income mutual funds are primarily affected by factors related to equities, not direct interest rate changes on fixed income. Question 6. Under the Investment Advisors Act of 1940, which of the following is not required to register as an investment advisor? A. An individual who provides investment advice solely to insurance companies. B. A person who, for compensation, advises others as to the value of securities. C. A bank. D. An individual who manages discretionary accounts for 10 high-net-worth clients. Answer, C. A bank. Under the Investment Advisors Act of 1940, banks are specifically excluded from the definition of an investment advisor and therefore are not required to register. The other options describe entities or individuals who would likely meet the definition of an investment advisor, providing advice about securities for compensation as a business, and would generally be required to register, unless another specific exemption applies. Question 7. A client is concerned about inflation eroding the purchasing power of their retirement savings. Which of the following investments is generally considered to offer the best protection against inflation? A. Treasury bills, T-bills. B. High-grade corporate bonds. C. Treasury inflation-protected securities, TIPS. D. Fixed annuities. Answer, C. Treasury inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are designed to offer the best protection against inflation. Their principal value adjusts semi-annually based on changes in the Consumer Price Index, CPI, and the coupon payments are then paid on this inflation-adjusted principal. Treasury bills, corporate bonds, and fixed annuities offer fixed or relatively fixed returns that may be significantly eroded by rising inflation. Question 8. Which of the following is a characteristic of a tenancy in common, TIC, account that differentiates it from a joint tenancy with right of survivorship, STROS, account? A. Upon the death of one tenant, their share automatically passes to the surviving tenant, S. B. All tenants must own an equal share of the account. C. The deceased tenant's interest passes to their estate. D. Only one signature is required for transactions in the account. Answer, C. The deceased tenant's interest passes to their estate. In a tenancy in common, TIC, account, upon the death of one tenant, their interest in the account passes to their estate, not automatically to the surviving tenant, S. This is the key differentiator from a joint tenancy with right of survivorship, STROS, account, where the deceased tenant's share does automatically pass to the survivor, S. In TIC, tenants can own unequal shares, and typically all owners' signatures or proper authorization is required for transactions depending on the nature of the transaction. Question 9. An investor purchases a municipal bond at a discount in the secondary market. The bond matures in 10 years and was originally issued at par. For federal tax purposes, how will the discount be treated? A. As a capital gain at maturity. B. As tax-exempt interest income over the life of the bond. C. As ordinary income over the life of the bond or at maturity. D. As a reduction in basis over the life of the bond. Answer, C. As ordinary income over the life of the bond or at maturity. For municipal bonds purchased at a discount in the secondary market, i.e., not an original issue discount, or OID, the discount must be accreted annually for federal tax purposes. This accretion increases the bond's cost basis each year. The accreted amount is considered ordinary income, which is federally taxable, whether recognized annually or upon sale/maturity. This differs from OID municipal bonds, where the accretion is treated as tax-exempt interest. Question 10. A portfolio manager is employing a strategy that involves frequently buying and selling securities based on short-term price movements and technical indicators. This strategy is most consistent with which investment style? A. Value investing. B. Growth investing. C. Market timing. D. Passive investing. Answer, C. Market timing. Frequently buying and selling securities based on short-term price movements and technical indicators is the hallmark of market timing. This strategy attempts to predict and profit from short-term market fluctuations rather than focusing on a company's fundamental value or long-term growth prospects. Value investing focuses on undervalued companies, growth investing on companies with strong earnings potential, and passive investing typically involves holding a diversified portfolio for the long term with minimal trading. Question 11. Which of the following would not be considered a security under the Uniform Securities Act? USA. A. A variable annuity. B. An equity indexed annuity. EIA. C. A real estate investment trust, REIT. D. A bond issued by a municipality. Answer, B. An equity indexed annuity. EIA. An equity indexed annuity. EIA is generally considered an insurance product, not a security, under the Uniform Securities Act. USA. While its returns are linked to an equity index, it typically offers a guaranteed minimum return and protection of principal, making it distinct from a direct investment in the market. Variable annuities, REITs, and municipal bonds are all explicitly defined as securities under the USA, requiring registration unless an exemption applies. Question 12. An investment advisor, IA, is subject to the brochure rule under the Investment Advisors Act of 1940. What is the primary purpose of delivering the Form ADV Part 2A, brochure, to clients? A. To provide a complete list of all recommended securities for the client. B. To disclose the IA's disciplinary history, services, fees, and conflicts of interest. C. To secure the client's explicit consent for discretionary trading. D. To provide quarterly performance reports for the client's portfolio. Answer, B. To disclose the IA's disciplinary history, services, fees, and conflicts of interest. The primary purpose of delivering the Form ADV Part 2A, the brochure, to clients under the Investment Advisors Act of 1940's brochure rule is to disclose essential information about the IA. This includes details about the firm's services, fees, methods of analysis, investment strategies, conflicts of interest, and any significant disciplinary actions. This disclosure helps clients make informed decisions about engaging the advisor's services, fulfilling a key aspect of the advisor's fiduciary duty. Question 13. A client inherited a substantial sum and wants to invest it for their grandchild's college education, which is 15 years away. They are comfortable with moderate risk. Which of the following investment recommendations would be least suitable? A. A 529 college savings plan. B. A Coverdell education savings account. ESA. C. A diversified portfolio of blue-chip stocks and growth mutual funds. D. Investing solely in certificates of deposit, CDs, and money market funds. Answer, D. Investing solely in certificates of deposit, CDs, and money market funds. Investing solely in certificates of deposit, CDs, and money market funds would be the least suitable recommendation for a college savings goal 15 years away with a moderate risk tolerance. While these are low risk, they offer very limited growth potential and would likely struggle to keep pace with inflation or the rising cost of college tuition over such a long time horizon. Both 529 plans and Coverdell ESAs are tax-advantaged education savings vehicles, and a diversified portfolio of stocks and mutual funds offers appropriate growth potential for a long-term goal with moderate risk. Question 14. Which of the following economic indicators is considered a coincident indicator? A. Stock market returns. B. Manufacturing new orders. C. Industrial production. D. Building permits. Answer, C. Industrial production. Industrial production is considered a coincident economic indicator, meaning it typically moves in tandem with the overall economy. Coincident indicators help confirm the current state of the economy. Stock market returns, manufacturing new orders, and building permits are generally considered leading indicators, as they tend to predict future economic activity. Question 15. An investment advisor representative, IAR, is discussing the capital asset pricing model, CAPM, with a client. The client asks what beta represents. The IAR should explain that beta measures a security's A. Total risk, including diversifiable and non-diversifiable risk. B. Systematic risk in relation to the overall market. C. Unsystematic risk specific to the company. D. Historical volatility independent of market movements. Answer, B. Systematic risk in relation to the overall market. Beta, in the context of CAPM, is a measure of a security's systematic risk, non-diversifiable risk, in relation to the overall market. A beta of 1 indicates the security moves with the market, a beta greater than 1 suggests higher volatility than the market, and a beta less than 1 suggests lower volatility. It specifically quantifies how sensitive a security's returns are to changes in the market's returns, not total risk or company-specific unsystematic risk. Question 16. Under the Uniform Securities Act, USA, which of the following statements regarding the registration of an investment advisor? IA, is true. A. All IAs must register with the SEC. B. IAs with less than $25 million in AUM must register with the SEC. C. IAs are generally required to register with the state administrator if they have a place of business in the state or solicit more than 5 retail clients in the state. D. Federal covered advisors are exempt from state notice filing requirements. Answer, C. IAs are generally required to register with the state administrator if they have a place of business in the state or solicit more than 5 retail clients in the state. Under the USA, an investment advisor is generally required to register with the state administrator if they have a place of business in the state or if they solicit more than 5 retail clients, the de minimis exemption, in the state. IAs with less than $100 million in AUM typically register with the state. Federal covered advisors, while registered with the SEC, are typically subject to state notice filing requirements, not exempt from them, ensuring states are aware of their operations within their borders. Question 17. A company issues 10-year bonds with a callable provision, allowing the issuer to redeem the bonds before maturity. This provision is most beneficial to the issuer if A. Interest rates rise significantly after issuance. B. Interest rates fall significantly after issuance. C. The company's credit rating deteriorates. D. Inflation increases substantially. Answer, B. Interest rates fall significantly after issuance. A callable bond provision is most beneficial to the issuer if interest rates fall significantly after the bonds are issued. In such a scenario, the issuer can call back the existing bonds, redeem them, and then reissue new bonds at a lower prevailing interest rate, thereby reducing their borrowing costs. Rising interest rates would make calling the bonds disadvantageous for the issuer, and credit rating deterioration or inflation primarily affect bond prices and investor perception, not the direct benefit of a call feature. Question 18. An investment advisor representative, IAR, is preparing for a meeting with a new client. To fulfill their fiduciary duty regarding client suitability, what is the most critical information the IAR must gather? A. The client's social security number and bank account details. B. The client's current net worth and annual income. C. The client's investment objectives, risk tolerance, and financial situation. D. The client's preferred communication method and meeting schedule. Answer, C. The client's investment objectives, risk tolerance, and financial situation. To fulfill their fiduciary duty regarding client suitability, the most critical information an IAR must gather is the client's investment objectives, risk tolerance, and comprehensive financial situation. This information forms the foundation for recommending suitable investments that align with the client's goals, capacity for risk, and financial resources. While other information is important for account opening and logistics, suitability is fundamentally about understanding the client's investment profile. Question 19. A soft dollar arrangement between an investment advisor and a broker-dealer involves A. The advisor paying the broker-dealer in cash for research services. B. The broker-dealer providing research and brokerage services to the advisor in exchange for commissions generated from client transactions. C. The advisor providing free investment advice to clients who agree to execute trades through a specific broker-dealer. D. The broker-dealer offering discounted commission rates to the advisor in exchange for a guaranteed volume of trades. Answer, B. The broker-dealer providing research and brokerage services to the advisor in exchange for commissions generated from client transactions. A soft dollar arrangement typically involves a broker-dealer providing research and brokerage services to an investment advisor in exchange for the advisor directing client transactions, and thus commissions, to that broker-dealer. These arrangements are permissible under Section 28(e) of the Securities Exchange Act of 1934, provided the advisor determines the commissions paid are reasonable in relation to the value of the brokerage and research services received. The key is that the advisor is receiving a benefit, research, that ultimately benefits their clients, even though it's not a direct cash payment. Question 20. Which of the following statements about municipal bond official statements is true? A. They are required to be filed with the SEC for all municipal bond issues. B. They must be provided to every investor at the time of purchase. C. They disclose material information about the bond issue and the issuer's financial condition. D. They are primarily used by institutional investors and are not readily available to retail investors. Answer, C. They disclose material information about the bond issue and the issuer's financial condition. The official statement for a municipal bond issue is a disclosure document that provides material information about the bond issue itself, including its purpose, terms, repayment schedule, and the financial condition of the issuer. Unlike corporate securities, municipal bonds are generally exempt from SEC registration, so official statements are not filed with the SEC. While not always physically delivered to every retail investor, they are available upon request and play a crucial role in investor due diligence. Question 21. According to the Investment Advisors Act of 1940, which of the following would be considered custody of client funds or securities? A. The advisor has discretionary trading authority over a client's account held at a qualified custodian. B. The advisor receives checks from clients made payable to third parties. C. The advisor accepts a client's securities for safekeeping in the advisor's own safe. D. The advisor has the authority to deduct advisory fees directly from client accounts. Answer: C. The advisor accepts a client's securities for safekeeping in the advisor's own safe. An investment advisor taking physical possession of client securities for safekeeping in the advisor's own safe unequivocally constitutes custody under the Investment Advisors Act of 1940. While discretionary authority and the ability to deduct fees are related to control, they generally do not, by themselves, trigger full custody requirements if the assets remain with a qualified custodian. Receiving checks payable to third parties is also not considered custody. Custody implies direct possession or control over client assets in a way that allows the advisor to misappropriate them. Question 22. A client is interested in an investment that offers professional management, diversification, and liquidity, with the ability to trade throughout the day like a stock. Which of the following best fits this description? A. Open-end mutual fund. B. Closed-end mutual fund. C. Exchange-traded fund, ETF. D. Unit Investment Trust, UIT. Answer: C. Exchange-traded fund, ETF. An exchange-traded fund, ETF, best fits the description of an investment offering professional management, diversification, liquidity, and the ability to trade throughout the day on an exchange like a stock. Open-end mutual funds offer professional management and diversification but are priced and traded only once per day, at NAV. Closed-end funds trade on exchanges but may trade at a premium or discount to NAV, and UITs are fixed portfolios that are not actively managed or traded throughout the day. Question 23. Which of the following actions by an investment advisor representative, IR, would be considered an unethical or prohibited business practice under the Uniform Securities Act? USA. A. Explaining the risks and benefits of a complex options strategy to an accredited investor. B. Recommending a diversified portfolio of mutual funds that includes funds from the IARs affiliated company, without disclosing the affiliation. C. Exercising discretionary authority in a client's account after obtaining written authorization from the client. D. Charging a performance-based fee to a qualified client as permitted by SEC rules. Answer: B. Recommending a diversified portfolio of mutual funds that includes funds from the IAR's affiliated company, without disclosing the affiliation. Recommending a diversified portfolio that includes funds from the IAR's affiliated company without disclosing the affiliation would be considered an unethical or prohibited business practice. This represents a conflict of interest that must be fully disclosed to the client, allowing them to make an informed decision. Explaining complex strategies to accredited investors, exercising discretionary authority with written consent, and charging permitted performance fees are all generally acceptable practices under relevant regulations. Question 24. A company issues commercial paper. Which of the following statements is true regarding commercial paper? A. It is a long-term, secured debt instrument. B. It is typically issued with maturities of up to 10 years. C. It is an unsecured promissory note, typically issued at a discount, with a maximum maturity of 270 days. D. It is primarily used by municipalities to finance short-term projects. Answer, C. It is an unsecured promissory note, typically issued at a discount, with a maximum maturity of 270 days. Commercial paper is an unsecured promissory note, typically issued at a discount, with a maximum maturity of 270 days. This short maturity exempts it from SEC registration, making it an attractive short-term financing tool for corporations. It is not a long-term or secured instrument, nor is it primarily used by municipalities, who use municipal notes, and its maturity is limited to 270 days, not 10 years. Question 25. An individual wants to establish a retirement account that allows for tax-deductible contributions and tax-deferred growth, with distributions taxed as ordinary income in retirement. They are covered by an employer-sponsored retirement plan. Which account type is most likely to meet their needs, assuming they meet income limitations? A. Roth IRA. B. Traditional IRA. C. Non-qualified annuity. D. Coverdell Education Savings Account. ESA. Answer, B. Traditional IRA. A traditional IRA allows for tax-deductible contributions, if income limitations are met and the individual is covered by an employer plan, tax-deferred growth, and distributions taxed as ordinary income in retirement. A Roth IRA involves after-tax contributions and tax-free qualified distributions. A non-qualified annuity offers tax-deferred growth but contributions are not deductible. A Coverdell ESA is for education savings, not retirement. Question 26. Which of the following is considered an ethical obligation of an investment advisor representative, IR, under the NASAA model rules? A. To guarantee a specific rate of return on client investments. B. To avoid all conflicts of interest, even those fully disclosed. C. To always place the client's interests before their own. D. To trade frequently in client accounts to maximize commission revenue. Answer, C. To always place the client's interests before their own. A core ethical obligation of an investment advisor representative, IR, under the NASAA model rules is to always place the client's interests before their own. This is a fundamental aspect of their fiduciary duty. IARs cannot guarantee returns, nor is it practical or necessary to avoid all conflicts of interest if they are fully and fairly disclosed. Trading frequently to maximize commissions would constitute churning, a prohibited practice that prioritizes the IAR's interests over the client's. Question 27. A client is reviewing their investment portfolio and asks about the difference between municipal general obligation, GO, bonds and revenue bonds. The IAR should explain that GO bonds are primarily supported by A. Fees and charges from specific projects. B. The full faith and credit and taxing power of the issuing municipality. C. Lease payments from an industrial corporation. D. Tolls collected from a specific highway or bridge. Answer, B. The full faith and credit and taxing power of the issuing municipality. Municipal general obligation, GO, bonds are primarily supported by the full faith and credit and the taxing power of the issuing municipality. This means they are backed by the issuer's ability to levy taxes, e.g., property, sales, income taxes. Revenue bonds, in contrast, are backed by the revenue generated from a specific project or facility, such as tolls from a bridge or fees from a utility. Lease payments from corporations are typically associated with industrial development revenue bonds, a specific type of revenue bond. Question 28. Which of the following types of orders is guaranteed to be executed at a specific price or better? A. Market order. B. Limit order. C. Stop order. D. Stop limit order. Answer, B. Limit order. A limit order is guaranteed to be executed at a specific price or better, if it is executed. It specifies the maximum price an investor is willing to pay, for a buy limit, or the minimum price they are willing to accept, for a sell limit. A market order is guaranteed execution but not at a specific price. Stop orders and stop limit orders become market or limit orders, respectively, once a trigger price is met, and therefore do not guarantee a specific execution price, only that they will be activated. Question 29. When recommending a Section 1035 exchange for an annuity contract, an investment advisor representative, IR, must ensure the transaction meets suitability standards and that a. The new annuity has a higher surrender charge than the old one. b. The client will incur significant taxable gains from the exchange. c. The exchange offers a tangible benefit to the client, such as lower fees or better features, despite any new surrender periods. d. The IAR receives a higher commission from the new annuity than the old one. Answer: C. The exchange offers a tangible benefit to the client, such as lower fees or better features, despite any new surrender periods. When recommending a Section 1035 exchange for an annuity, the IAR must ensure the exchange offers a tangible benefit to the client, such as lower fees, enhanced benefits, or more suitable features, even if it entails a new surrender period. The primary focus must be on the client's best interest and suitability, not on the IAR's commission or arbitrary changes. The exchange itself is generally tax-free, so incurring significant taxable gains is not the goal, and higher surrender charges are typically a downside that must be justified by superior benefits. Question 30. An investor owns a diversified portfolio of U.S. large-cap stocks. To reduce systematic risk and potentially enhance returns through diversification, which of the following asset classes would be least effective? A. International equities. B. Real estate investment trusts, REITs. C. High-yield corporate bonds. D. U.S. small-cap growth stocks. Answer: D. U.S. small-cap growth stocks. To reduce systematic risk and enhance diversification for a portfolio of U.S. large-cap stocks, U.S. small-cap growth stocks would be the least effective. While they represent a different segment, they are still highly correlated with the overall U.S. equity market and subject to similar systematic risks. International equities, REITs, and even high-yield corporate bonds, which have a different risk profile than equities, generally offer lower correlation to U.S. large-cap stocks, thus providing better diversification against systematic risk. Question 31. Which of the following federal acts primarily governs the registration and regulation of investment advisors? A. Securities Act of 1933. B. Securities Exchange Act of 1934. C. Investment Company Act of 1940. D. Investment Advisors Act of 1940. Answer: D. Investment Advisors Act of 1940. The Investment Advisors Act of 1940 is the primary federal legislation that governs the registration and regulation of investment advisors. It defines who is an investment advisor, outlines their fiduciary duties, and sets forth requirements for registration with the SEC. The other acts cover different aspects of securities regulation. The 1933 Act covers new issues, the 1934 Act covers secondary market trading and broker-dealers, and the Investment Company Act of 1940 regulates investment companies like mutual funds. Question 32. A high-income client wants to contribute to a retirement account that allows for tax-free qualified distributions in retirement. They are concerned about exceeding income limits for direct Roth IRA contributions. Which strategy would best allow them to achieve their goal? A. Contributing to a traditional IRA and taking a non-qualified distribution later. B. Making a non-deductible traditional IRA contribution and then converting it to a Roth IRA, backdoor Roth. C. Contributing to a SEP IRA. D. Relying solely on their employer's 401(k) plan. Answer B. Making a non-deductible traditional IRA contribution and then converting it to a Roth IRA, backdoor Roth. For high-income individuals exceeding direct Roth IRA contribution limits, backdoor Roth strategy is often used. This involves making a non-deductible contribution to a traditional IRA and then converting those funds to a Roth IRA. While the conversion itself might be taxable if there are pre-tax IRA funds, pro rata rule, this allows for future qualified distributions from the Roth IRA to be tax-free. This strategy addresses the income limitation concern while aiming for tax-free retirement distributions, which is the primary benefit of a Roth IRA. Question 33. When calculating the current yield of a bond, an investor would divide the annual interest payment by the bonds. A. Par value. B. Current market price. C. Yield to maturity. D. Yield to call. Answer B. Current market price. The current yield of a bond is calculated by dividing the bond's annual interest payment, coupon, by its current market price. This calculation provides investors with a measure of the income generated by the bond relative to its current cost. It differs from yield to maturity or yield to call, which account for capital gains or losses and the time value of money, and par value, which is the face value, not the market price. Question 34. Which of the following is a key characteristic of a private placement under federal securities law? A. It is generally offered to a broad public audience through advertising. B. It is exempt from SEC registration requirements, typically offered to a limited number of sophisticated investors. C. It must be registered with the SEC but is exempt from state registration. D. It is exclusively for government securities and municipal bonds. Answer B. It is exempt from SEC registration requirements, typically offered to a limited number of sophisticated investors. A key characteristic of a private placement under federal securities law is that it is exempt from SEC registration requirements. These offerings are typically made to a limited number of sophisticated or accredited investors who are deemed capable of evaluating the risks. Unlike public offerings, private placements avoid the extensive disclosure requirements of full SEC registration, making them a common way for companies to raise capital quickly from a targeted group of investors. Question 35. An investment advisor representative, IAR, is determining the suitability of an investment for a client. Which of the following client characteristics is generally considered most subjective and difficult to quantify? A. Age. B. Current income. C. Risk tolerance. D. Net worth. Answer C. Risk tolerance. Risk tolerance is generally considered the most subjective and difficult client characteristic to quantify. While factors like age, income, and net worth are objective and readily measurable, risk tolerance involves a client's emotional willingness and psychological comfort with potential investment losses, which is highly personal and can be influenced by various non-financial factors. IARs must employ careful questioning and discussion to accurately assess a client's true risk tolerance.